G'day folks, Jim here from Orchard Forex. It is Saturday the 28th of November. Well, thin holiday conditions in the US have meant a quiet end to the week, although the dollar remains under severe downside pressure and looks like breaking long-term support against multiple currencies. While the US stock markets, the S&P, the Nasdaq and the Russell small cap index in particular, all closed the week at new all-time high closing levels. The commodities are looking interesting, with the precious metals breaking lower through some important support, while oil seems to be finally on its way trending higher again, and with West Texas Intermediate possibly looking as though it's going to test $50 in the coming weeks. There's an OPEC meeting on Monday, of course, which will provide the direction here though. Also in the coming week's calendar, we see the PMIs and the non-farm payrolls amongst other items, so it could be a busy run into the end of the year, and I'll go through the calendar at the end of the video, but starting off with the trends table as normal. Okay, as we can see from the currencies against the dollar, initially the Aussie looks reasonably bid, so does the Kiwi. It's well above 70 cents now. It's at 70 and a quarter or so. The euro looks as though that could be turning higher. It's breaking through some important resistance, while sterling, on the other hand, may be forming a topping formation, and the outcome of the Brexit talks, which are reaching the sharp end, they'll provide the next direction for sterling. As far as the stock markets go, I still like them high, but I think we may, well, the S&P did finish in new all-time high, as I said. I'm not sure whether that's got the momentum to carry on early in the week. We may see a little bit of consolidation, but longer term it still looks healthy. The gold and silver look increasingly heavy, I have to say. Oil looks a little bit mixed, but the dailies are beginning to turn high. We'll go and have a look at them. And as far as the crosses go, well, I'd stay pretty clear, I think. If anything, looking to be short sterling against the Aussie and also against the euro, maybe a trade, but realistically I think there are better things out there to be looking at. So without further ado, we'll go and have a look at the euro. Now I'm starting with a monthly chart of the euro here, and as you can see, it looks as though we are breaking a considerable amount of resistance here. Both the long-term downtrend going back to 2007 and this blue line here, which marks the 100-month moving average. So I think we probably are headed higher over time. I wouldn't get too carried away at this point in time, but the monthly indicators are looking positive. And really the same applies to sterling, although Brexit might throw a spoke in the works. We'll have a look at a monthly sterling chart, and that looks fairly similar, but it has yet to break the trend line, and the indicators are not. They haven't really got any real momentum behind them. If we do break above this or 135 level, then I think we can head a fair bit higher. But we finished the week at 133. Having got up to 133.80 on Friday and 134. This monthly candle here saw a run up to 134.80. So that 134.80, 135 is going to be strong. But beyond that, there's not much until we get up to the first FIBO level, so 137 or so. So I think that's fairly interesting and needs to be watched. The Aussie monthly chart, not quite so exciting, but we might be heading up towards FIBO resistance, seen here at around sort of 76 cents. That's some way off at this stage. I wouldn't be getting too excited yet. There's plenty of work to be done before then. But let's come back to nearer home, and starting with a 4-hour euro chart. Well, this level here is sort of 120.10, 120.15. That's going to be a big hurdle to overcome. The 4-hour charts are pointing a little bit higher. And I do think the euro remains supported, particularly with the dollar index now breaking down. I'll show you some technicals there in a second. But the 4 hours are looking fairly perky. So are the dailies. And more importantly, if we go and look at the Ichimoku chart, this is a monthly chart of the euro. And you can see we're in the cloud at the moment, so 119.50 or so. but the top of the cloud coincides with that level on the 4-hour charts we showed before. So just above 120, and if we break above there, then I think we're really going to motor on. So 120 to 120.50 is going to be a huge level, I think. We're probably likely to chop around there if we, as long as we get that high, of course. I think we're going to chop around there for a little while, but eventually I think we're probably going to head higher. But that probably isn't going to come until January, when the Biden administration begins to take over, and given that the market thinks that the new administration will provide huge amounts of liquidity in order to combat the pandemic, that should see the US dollar come under pressure, and that I think is what will probably drive the euro higher. So going forward and looking at sterling in the short term, well, cable looks a little bit heavy on the 4-hour charts here. And I'm not sure I really want to be long of it at the moment. So there's too many issues in the air with regard to Brexit. So sterling could really go quite sharply either way. If I was going to be trading it, I'd probably trade sterling on a short basis via the cross and be long euro, short sterling, or even long Aussie, short sterling. But the 4-hour charts do look heavy. The dailies, likewise, they might be forming a bit of a top. But at the end of the day, it might be just that sterling is consolidating around here, as no one really knows what to do with the Brexit talks. So I think I'll probably leave sterling alone for the time being. The Aussie, though, I do like, and as I said before, it seems to be breaking above this long-term resistance line, and realistically, the next point of resistance comes just above 75, or around about, call it 75 cents. That being the 76.4% retracement of the level falling from here back in October 2017. Coming back to nearer home for Monday, I would expect it to be fairly choppy. We've got the RBA meeting on Tuesday, don't forget. So I'd be surprised to see too much action in the Aussie unless there's a major sell-off in the US dollar. The 4-hour indicators aren't telling us an awful lot. Although the dailies may be picking up some speed, but they have to overcome this high here at just above 74.15, I think it was, 74.13. So that's going to provide resistance, and it's still 30 to 40 points way off at the moment. But overall, I prefer to be long Aussie than short. And I'd probably have a stop loss, as I think I said before last week, somewhere around this, just under 72.5. So I'd be looking to buy dips and keeping a stop loss down there. Pretty much the same applies to the Kiwi. We'll just have a quick look there. So the Kiwi's also broken above long-term trend resistance, and the next port of call would seem to be the FIBO level at 70.70. So that's we're at 70.20 at the moment. But the weeklies look positive. The dailies equally are looking pretty good. So once again, I prefer to look to be long. I probably have a stop loss now under about, well, call it a big figure away, so 69.20. But I'd be buying dips down towards that level, looking for an attack on 71. But that may, as I say, it may not come as yet, and it may be that the US dollar will really begin its acceleration not until January, when the Biden administration takes over. While we're still on the currencies, this is a monthly chart of the US dollar index, and as you can see, it's breaking down through this long-term rising trend support, although the yellow line here is the 100-month moving average, and we're sitting on that support, so it may yet hold. But the indicators are definitely pointing to the downside. So I think eventually we are going to see a break. It may be too early to think of that yet. And if we come back nearer home and look at the dailies and the weeklies, the dailies are drifting a bit lower, but we're still holding above this previous low here, which was at 91.75 in early September. The weeklies haven't got an awful lot of downside momentum either. So it may be that this support holds for the time being, as I say, but I think come January, it may be before then, but come January, that's when we're going to start to see the real movements. So moving away from the currencies and towards the stock markets. Okay, so here we have a daily Standard & Poor's 500 chart, and the S&P did make a new all-time high close on Friday. Although, having said that, the indicators aren't telling us an awful lot. They look a little bit flat. And as I said before, although we've got higher highs here, the RSIs and the stochastics may be running out a bit of steam. Now, there's no point in trying to fight the trend because that's definitely headed higher. But I do think I would be implementing trailing stops the whole way up, because it could be that we might see quite a vicious spike lower at some stage, although that's not being hinted at yet. The weekly charts are pointing higher. Once again, we can see this bearish divergence. We've got higher highs but lower highs. But the weeklies are pointing higher, so that's a good sign. And I think for the time being, I still prefer to buy the dips, and that's the way I'm looking at it going into January. I think if the Biden administration do chuck as much into the market as is predicted, then asset prices will remain inflated. And given that you're earning 0% in your cash account, you have to buy risk assets, and the stock market will obviously be one of the main beneficiaries, I think. Much the same here applies to the Nasdaq, which that made a new all-time closing high on Friday, and the daily charts look pretty positive. So look, once again, I prefer to be long than short, but I would be running a trailing stop. The weeklies, I have to say though, we do have this bearish divergence, and so you need to be a bit careful. The monthlies are very overbought, but at this point in time, there's no sign of turning around. So I think we have to go with it. While we're looking at the stock market, so this is a chart of the Russell 2000 Small Caps Index. And as you can see, it had an extraordinary November run, up about 11% over the course of the month, to well above all-time highs. And the monthly charts do look very positive. So I think, once again, I prefer to play that from the long side. You can't really trade this through the MT4 platform that I use, but it's just worth noting this anyway. The weekly charts, likewise, looking very positive. If I was trading this, I would prefer to buy dips, but I think this is a barometer of where the market in general is headed. But while we are on here, I think I'll just show you a quick chart of the VIX. Now, the VIX is not a tradable product on MT4, but the VIX is basically a derivative index of option prices tied to the S&P 500 index, which traders often tap into to hedge portfolios or to make directional bets on stocks. And as you can see, we still remain at quite elevated prices compared to last year. And that suggests that concerns do linger that the volatility that gripped the market earlier in the year could yet return. So it's just a warning, really, that we shouldn't be placing all our money on a one-way bet for stocks to head higher. There's going to be some seriously volatile conditions ahead. But overall, I still think probably buying dips is the way to go as the economic recovery takes place. So moving along to the Australian stock market, this is a daily chart of the SPI 200. Now, I've been following this fairly closely. I really like this move higher. I think it has got more in it yet, but for the time being, the dailies do seem to be topping out a little bit. We've had a really good run higher. And let me just go back to a 4-hour chart here. So we've had a really good run higher. I wouldn't be surprised to see some consolidation between current levels and say 6,500 over the next few days. But the weeklies suggest to me, we'll go forward to the weeklies here, that we could yet see a decent run back higher towards 7,000. And talking to a couple of people involved in the professional stock market here in Australia, they tend to have the same view that we could well see 7,000 again in the days and weeks ahead. Don't forget, we've got the RBA meeting on Tuesday. If they're particularly dovish, then that could be a further boost to the Australian stock market as further liquidity comes on board. We'll have to wait and see on that one, but the weekly indicators are pointing higher, and the monthlies not doing an awful lot really. But no, I wouldn't put too much leeway in anything there. But like I say, the weeklies are suggesting that we can head higher yet. So moving along to commodities, things are not looking quite the same there. And here we have a daily chart of gold. And as I said last week, we needed to hold on above 1,800, and this 200-day moving average, and we failed to do that on Friday. It broke down to 1785. The dailies are pointing lower. The weeklies are even worse. They're really looking very heavy indeed. I think we've probably got more downside to come. The 4-hour charts not looking very healthy either, and it looks to me that the next support is going to come around these lows here, basically where we currently are, and then 1760, which is about the 50% level. So I'd be looking probably to sell rallies now with a stop loss. Well, that's back up at 1815 or so. So sell into strength to around 1800, but I'd have a stop loss above 1815, 1820, something like that. Looking for 1760 as an immediate target. Silver looks somewhat the same, possibly not quite so bad, but that's a weekly chart. We'll go back to the 4 hours. It broke down through this support on Friday afternoon. Okay, having added in some FIBO levels there, we've broken down through here. So the next support is going to come around this low here, around 2170 or so, and below there, I guess we can move back to 2070. That's some way off at this point in time. And the indicators, the 4-hour indicators, may be pointing mildly lower. The dailies, likewise, they don't have the same momentum as gold, although the weeklies do look very heavy. So I would, once again, I will be looking to sell into strength in silver, probably with a stop loss somewhere above these highs here. So that's sort of 23.40 or so, 23.50. Now finally we'll go and look at oil. Okay, so oil, this red area is the huge resistance that I pointed out over the last 6 months or so, but we did break above it. Didn't carry on. It was Thanksgiving, so the market didn't really have the momentum, but it still made a good end to the week. It's trading at 45.5, which means it's broken above this previous level here, so 43.5, which has been containing it for quite some time. Now the 4-hour charts are not really showing us any great positive momentum for Monday, but the dailies are pointing higher. As you can see, we're taking out various levels of resistance here, and actually we probably see on the weeklies better. We had this massive head and shoulders, which took us basically down to zero, as you may remember in earlier in the year. I can't remember where, August apparently by the looks of it, and so we had this head and shoulders with this massive neckline here, and on Friday or at the end of last week we've actually moved to finish right at the top end of that. So I think now we can possibly start to move on. I'd be looking to buy oil on a dip to that 43.5 level. Certainly have a stop loss below sort of 42.5, I think 42, something like that. But I'm looking for a move towards 50 and then possibly even up to 55. But I think that is some time away yet. Don't forget there's an OPEC meeting on Monday, and oil will take its direction from there during the week. So that's worth keeping an eye out for. So before we finish up, we'll just go and have a quick look at the calendar. Okay, so we've got some secondary Japanese, New Zealand and Australian data out early on Monday morning. The Chinese manufacturing, non-manufacturing PMIs will probably be the big event of the day. There's not an awful lot else on. We have got the German inflation numbers out, the preliminary numbers for November. We've got some regional Fed activity numbers coming out later in the day. As far as Tuesday goes, it's really all about the manufacturing PMIs through the day. As we can see, they're coming out, starting with Australia and then going through Europe and the US. And also China, of course. We've also got the RBA interest rate decision, although policy is expected to stay on hold, and the interest will be in what the statement has to say. We've got German unemployment numbers as well, and European preliminary inflation figures for November. We've got the Fed Chairman Jay Powell. He'll be testifying to Congress on Tuesday afternoon, and we've also got the ISM numbers. So that's going to be a big day for numbers, I think, and possible for volatility. Wednesday, we've got various central bank speakers. We've got the Australian Q3 GDP. That'll be fairly closely watched. Then we've got the ADP numbers coming out of the States later in the day ahead of Friday's non-farm payrolls. More Fed speakers. And then Thursday, bits and pieces. The services PMIs will be and the composite PMIs will be the main event really throughout Thursday. And of course, we've got the jobless claims later in the day. They're always important. So on Friday, we've really just got two events. There's the Australian retail sales for October, and then it all goes pretty quiet until we get the US unemployment numbers. Non-farm payrolls looks like expected to show 520,000 jobs created, with a headline rate of 6.8%, but we'll see on that one. So that's about it for the coming week. It's going to be pretty active, could be pretty busy, especially if we break through some of those support and resistance levels. So enjoy your week's trading. Hope it goes well for you, and we'll talk to you next week. Cheers.